In this video, we're going to analyse Diageo to see if it is the safest stock in the UK or just overpriced rubbish. And no, I did not get attacked by a cat or participate in wild sex. These marks are from martial arts, so please don't worry. Diageo's revenue has seen a moderate increase of 33% in the last 5 years. However, free cash flow has grown at a much slower pace of 6%. In this same time, the market capitalisation has fallen by 6%. And so it asks the question, is this an opportunity to buy, or does it suggest that shares may continue to stagnate and we should avoid it? Well, when we look at profitability, Diageo has seen profits increase by 18% since 2019, which means that profits have grown at a slower pace than the revenue, suggesting that there's potentially greater inefficiencies leading to a shrink in the profit margins of 11%. That said, it is still a very healthy profit margin standing at 22%. Interestingly, by looking at the ROIC of Diageo, which is 19.7%, it would suggest that the company is more efficient than 5 years ago. But doesn't that contradict what I've just said about profit margin shrinking? In fact, it does, and I actually want to go a step further to demonstrate how this is worse than it seems. When we look at the total share count, it has reduced by 5% since 2019. Share buybacks mean that the remaining shares receive a larger portion of the company's profits, which causes an increase in the earnings per share. We can see that the EPS has improved by 26% in the same time. When a company buys back its own shares, its equity on the balance sheet reduces, which means that a company's capital employed is less, leading to an increase in the return on capital employed even when profit margins are shrinking. So does this mean that Diageo is a value trap? Simple answer, it's complicated. This is still a respectable ROIC, and its 10-year average is actually 17%, which suggests sustainable profitability and efficiencies even whilst having the impact of the pandemic. Plus, it's a big company, so we can't expect it to grow as fast as the smaller fish. That said, the balance sheet does paint a different picture. Cash has improved by 55% over the last 5 years, but the debt has also increased by 34%. This has driven a net position that has not only remained negative but had a strong downwards trend from minus 1.4 billion in 2019 to minus £6 billion in 2023. Combined with share buybacks reducing that equity figure by 9%, this has fueled the debt to equity ratio increase of 46% in the last 5 years. It currently stands at 182%, which is certainly on the high end, and debt is currently 6 times more greater than the free cash flow in 2023. That said, the current ratio of 1.6 times does imply financial strength and does mean that Diageo can pay its current liabilities with its current assets, although the quick ratio is 0.5 times and infers pretty much the opposite. But the only difference is in this one is that Diageo would be more pressed in a financial crisis because their liquid assets do not cover its current liabilities, basically meaning that Diageo likely has a large inventory. Given the deterioration of the balance sheet over time, the reduction in that net value figure, does this mean that this so-called safe dividend is at risk? Well, Diageo has a phenomenal dividend track record, and it has increased its dividend every single year since 2000. It's likely longer than this amount, but my data only goes back this far. And in the last 10 years, you can see that dividend has grown by a compound annual growth rate of 5.4% each year on average. And as you can see, the dividend per share has actually grown at a slower pace than the earnings per share, showing the conservative long-term nature of the management. This has driven an improvement of the dividend cover of 8%, which might infer that they can grow, if they wish to, the dividend at a slightly faster pace in the next few years. This dividend yield may seem low to typical dividend investors at 2.6%, but it is steadily approaching the 5-year high of 3.2%, which might mean it could be a good time to buy shares of Diageo for a decent yield and upside potential. But is this stock really a good value to purchase? Well, relative valuations indicate that Diageo is trading near its 52-week lows. However, it trades at a significant premium to the UK market average for both price to earnings and price to sales, suggesting that investors are willing to pay more for less earnings in this stock, likely as they believe it to be a very defensive investment, and perhaps they believe the cash flows of the company to be more resilient than that of the market. The risk with defensive companies is the compression of that valuation multiple. So we need to look at a longer term picture. Historically, over the last 10 years, Diageo has traded at 25.2 times price to earnings, which has increased in the last 5 years to an average of 29.1 times. That said, the current PE ratio is below that figure and could indicate good value versus its historical averages. The growth rate combines revenue, earnings and dividend growth into one average figure over the last 10 years. This number for Diageo is 5%, which is certainly acceptable but far from high growth. The trouble is that if we were to buy Diageo shares at this price, we would still be paying quite a premium for a company with limited growth. Based on my discounted cash flow valuation, I think the shares have a fair value with a good margin of safety at £25.35, but I can see the merit in cautiously averaging down at current prices, provided the investor is disciplined and starts in a very small position. But wait, wasn't my price target significantly lower than the current share price, yet I have shown interest in buying shares? Well, I think Diageo will find it very hard pressed to really stoop to that price target, and I wouldn't look at this stock for value or growth. Instead, I'd look towards Diageo as a very defensive investment with some dividend growth. So if you are an investor that perhaps looks towards growth stocks, perhaps you want some stability in the portfolio, and Diageo can add that level. Just be warned, it is on a downtrend at the moment, and that's why I say to cautiously average down in my opinion. However, perhaps Diageo's dividend isn't as high as you'd like. Is there another stock that could generate these strong results? Well, yeah, watch this video next to learn if Lloyd's is a value trap or a golden dividend opportunity.